Financial ratios are key metrics that allow investors, analysts, and business owners to assess the financial health of a company. These ratios are calculated using information from a company's financial statements and can provide valuable insights into a company's liquidity, profitability, efficiency, and stability. Let's take a closer look at some of the top financial ratios and how to interpret them. Current ratio. The current ratio is a measure of a company's ability to pay its short-term obligations. It is calculated by dividing a company's current assets by its current liabilities. A current ratio of 1:1 is considered ideal, as it indicates that a company has enough assets to cover its liabilities. However, a ratio lower than 1:1 may indicate that the company is having trouble meeting its short-term obligations and may struggle to pay bills or repay loans. Debt-to-equity ratio. The debt-to-equity ratio is a measure of a company's leverage, or the extent to which it relies on debt to finance its operations. It is calculated by dividing a company's total debt by its total equity. A high debt-to-equity ratio may indicate that a company is taking on too much debt and may become over-leveraged. On the other hand, a low debt-to-equity ratio may indicate that a company is financially stable and has a strong balance sheet. Gross profit margin. The gross profit margin is a measure of a company's profitability, or the amount of revenue left after accounting for the cost of goods sold. It is calculated by dividing a company's gross profit by its total revenue. A high gross profit margin may indicate that a company is selling its products or services at a high markup, while a low gross profit margin may indicate that the company is struggling to turn a profit. Return on assets, ROA. The return on assets, ROA, is a measure of a company's efficiency, or the amount of profit it generates relative to the amount of assets it holds. It is calculated by dividing a company's net profit by its total assets. A high ROA may indicate that a company is making good use of its assets and generating a high return on investment, while a low ROA may indicate that the company is underperforming and may need to improve its asset utilization. Price to earnings, PE, ratio. The price to earnings, PE, ratio is a measure of a company's stock market performance, or the relationship between its stock price and its earnings per share, EPS. It is calculated by dividing a company's stock price by its EPS. A high PE ratio may indicate that a company's stock is overvalued, while a low PE ratio may indicate that the stock is undervalued. In conclusion, these are some of the top financial ratios that can be used to assess the financial health of a company. It is important to consider these ratios in the context of a company's industry, competitors, and overall financial performance, as they can provide valuable insights into a company's strengths and weaknesses. Use code BLOG to receive 25% on your next purchase.